Bismillahirrahmanirrahim. This is the first video on elimination of unrealized gains or losses on the intercompany sales of non-depreciable assets. In this video, we are going to present the accounting treatment for the eliminations of intercompany transactions related to non-depreciable fixed assets. So, we are going to talk about land in this video, focusing on any intercompany gains or losses on sale of land. Next, we will solve exercises on elimination of unrealized gain or losses on intercompany sales of land. We will solve exercises on intercompany sales of land, upstream and downstream sale of land, and calculate gain on sale of land. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope that this video helps CPA, AICPA, ACCA, CMA and other accounting program aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning on elimination of unrealized profit on intercompany sales of non-depreciable assets. Let us start with the accounting treatment for the eliminations of intercompany transactions related to non-depreciable fixed assets, that is land. It is important to note that any gain or loss resulting from an intercompany sale transaction is not realized from the perspective of the consolidated financial statements until the transaction is executed with an outsider. When dealing with intercompany transactions, it is important to differentiate between upstream and downstream transfers to understand the mechanism of the transaction and assess the potential effect on non-controlling interest. In cases where the parent company owns less than 100% of the subsidiary. If the parent company owns 100% of the subsidiary, it doesn't make a difference. Let us talk a bit more about it in the next slide. An upstream transfer refers to a transaction in which the subsidiary company is transferring an asset to the parent company. Therefore, the subsidiary, being the seller, would report the results of the transfer as a gain or loss in its financial statements. Remember that the parent and the subsidiary, they keep their books separately. If the subsidiary is not wholly owned by the parent company, a portion of the results of this transaction is attributable to the non-controlling interest. If the parent company owns 100% of the subsidiary, then they get 100% of the gain or loss. A downstream transfer refers to a transaction in which the parent company is transferring an asset to its subsidiary. Therefore, the total amount of gain or loss is attributable to the parent company. In case of downstream sales, we don't have to worry about the non-controlling interest because the parent company is selling to the subsidiary. Therefore, the total gain or the loss is attributed to the parent company. The subsidiary has nothing to do with this transaction. The intercompany sale of a non-depreciable fixed asset is obviously easier to eliminate then the intercompany sale of a depreciable fixed asset that we will talk about in the next video. When parent is selling a non-depreciable asset, the parent will report a gain in its books, but this gain is unrealized from a consolidated financial statements perspective. On the other hand, the buyer would report an inflated or overvalued asset. Let us talk more about it with the help of a example. Parent company has a piece of land worth 100,000. They sold this piece of land to the subsidiary for 120,000. So the parent company in its books will report the gain of 20,000 and the subsidiary in its books will report the purchase of land for 120,000. From accounting perspective, two problems need to be resolved. First, the gain of 20,000 in the books of the parent company should be eliminated. Second, land is owned by both the parent company and the subsidiary, and the subsidiary in its book has recorded land for an additional 20,000 in the land cost. Therefore, the true cost would still need to be 100,000 and not 120,000. Therefore, the eliminating journal entry consists of simply eliminating the intercompany gain recorded by the parent company by restating the assets at its original cost. We would remove the gain and we will deflate or reduce the asset back to its original value. The only case when the gain or sale of land of a non-depreciable asset appears in the consolidated income statement is when the buyer of the asset is a outsider, the third party. Let us talk more about it in an illustration on the next slide. During year 1, P company, owner of 85% company S common stock, sold a piece of land initially bought for 210,000 to S company for 300,000. Prepare the eliminating journal entry required for consolidation purposes at the end of year 1. So, land is recorded in the books of the parent company and the subsidiary, both. At the end of the year, the two company accounts is to be consolidated, and we have to resolve two problems at the time of preparing the consolidated financial statement. First, we need to eliminate the gain because this gain is an intercompany gain as land is not sold to an outside party. And second, land is listed for 300,000 but it should be listed for 210,000. So we also have to reduce the land by 90,000. Therefore, the eliminating journal entry at the end of the year will be debit gain on sale of land and credit land by 90,000. And by doing so, we fixed the problem. We eliminated the intercompany gain by debiting the gain and we reduced the land by 90,000, thus restating the land as well. Now, this transaction is a downstream transfer of a non-depreciable asset because P is the seller and S is the buyer. This transaction has no impact on non-controlling interest because non-controlling interest is when the subsidiary sells to the parent and the parent owns less than 100% of the subsidiary. Now, we have to be aware about subsequent years because remember this entry is a consolidated entry and it does not go on P's book or the S book. So every year, as long as the subsidiary keep the asset, we have to eliminate that gain. So let us go to the subsequent year. At the end of the year of sale, the gain reported on the sale of land is closed to the retained earnings along with all the other items reported on the income statement. Therefore, in the years following the year of sale, until the land is sold to an external party, the eliminating journal entry would include debit to retained earning account and credit to land for the amount of gain previously recorded. Simply put, in year 1, land is not sold to outside party, and year 2, land is overstated in the subsidiary books, and still there is a gain that's now reported in the retained earning. So the eliminating journal entry in year 2 will be retained earning debits and land is credited by 90,000. So in subsequent years, we have to reduce retained earnings by debiting retained earning as we cannot debit gain in subsequent years, but this gain is still sitting in this retained earning. So we have to debit retained earning and credit the land. We keep doing so until the land is actually sold to outside party. Now let us take a look at an upstream sale of land. Assume now that the subsidiary S company is the seller and P company is the buyer. Prepare the eliminating journal entries by the end of year 1 and 2. The cost of the land was 210,000 as it was in the previous example, and the selling price was 300,000. So you see the numbers I have not changed. It is now the difference is that the subsidiary is selling to the parent company and this is a upstream sales, and when this is an upstream sale, that is when the subsidiary is selling, there is a inclusion of a non-controlling interest. So the journal entry will be land debit and cash credit for the parent company because it is the subsidiary who is selling, and for the subsidiary cash is debit, land is credit and gain is credit. The eliminating journal entry at the end of the year would include a debit to the revenue account, that is the gain on sale of land for the parent share of 85%. 85% of 90,000 and a debit to the non-controlling interest for the remaining share of 15% attributable to non-controlling interest. So debit gain on the sale of land 76,500, debit non-controlling interest 13,500 and credit land by 90,000. In year 2, the eliminating journal entry would include a debit to the retained earning for the parent share of 85% and a debit to a non-controlling interest for the remaining 15%. As a result, the eliminating journal entry at the end of year 2 would include a debit to the revenue for the parent share of 85% and a debit to a non-controlling interest for the remaining 15% attributed to the non-controlling interest. We have credited the land to record it at the cost to the affiliated group. Now, because the parent company owns 85% of the subsidiary equity, simply put, we are going to reduce the gain in upstream intercompany sales of land of 90,000 by reducing the non-controlling interest, share in gain on sale of land by 15% and reducing 85% parent share in gain on sale of land by 85%. In year 2 again, we are going to do the same thing except that in year 2 there is no gain. So there is, you can see there is no gain in year 2, and the gain on sale of land becomes retained earning. NCI remains the same, the non-controlling interest, and land is credited as in the first year, because every year we have to do so until the land is sold to a outside party. It is important to note that the parent company would continue to report the land for 300,000, as the parent company bought it for 300,000, and the consolidated balance sheet would show the land at its original cost of 210,000. Next, let us solve an exercise on intercompany sale of land. Procter Company owns 90% of the outstanding stock of Silex Company. On January 1, 2011, Silex Company sold land to Procter Company for 350,000. So this is an intercompany sale of land by the subsidiary to the parent company. Silex has originally purchased the land on June 30, 2007 for 200,000. Procter Company plans to construct a building on the land bought from Silex, in which it will house new production machinery. The estimated useful life of the building and the new machine is 15 years. So this is not this is redundant information in this exercise. We are not going to use this. Prepare the entries on the books of Procter related to the intercompany sale of land for the years ended December 31, 2011 and December 31, 2012. So the journal entry in the books of the parent company for this is part A, and this is for the year 2011. So land will be debit for the price they are paying, that is 350,000, and cash is credit for 350,000. For the year 2012, no further entries are recorded in the books of the parent company, because still the land is not sold to outsiders. So we have done with part A. Let us go to part B. Prepare in general journal form the work paper entries necessary because of the intercompany sale of land in the consolidated financial statement work paper for the year December 31, 2011. Now for we are talking about the work paper, yes, only for the elimination. So when the cost of the land was 200,000 and they have sold for 350, so we have to eliminate the gain of, there is a gain of 150,000. So let me put it as part B. For the year 2011, gain on sale of land will be debit by 150,000 and land will be credit by 150,000. Okay. We go to part B, and the second part, the consolidated financial statement work paper for the year ended December 31, 2012. Now for the year 2012 there is no gain, and we can record this either by cost method or rather even the partial equity method, it will be the same. So gain on sale of land will be substituted by beginning retained earning, and this is going to be for the parent company. And you see they have acquired 90%, so 90% of 150,000, that is 130, 90% of total gain of 150,000. that is equal to 135. It is debit by 135,000, and non-controlling interest will be debited by 10% of the gain, that is 150,000. So that is 15,000, and land will be credited by 150,000 because it is overstated by a gain of 150,000. Now, if we are going to follow the not the cost method or the partial equity method, but if it is, say, we are going to follow the complete equity method, then the beginning retained earning will be substituted by investment in subsidiary. So investment in subsidiary will be debit by 135,000. Non-controlling interest will be the same 15,000, and land will be credited by 150,000. Next, let us solve an exercise on calculating gain on sale of land. So P company owns 90% of the outstanding common stock of S company. On January 1, 2012, S company sold land to P company for 600,000. S company originally purchased the land for 400,000. On January 1, 2013, P company sold the land purchased from S company to a company outside the affiliated group for 700,000. So we have to calculate the amount of gain on the sale of the land that is recognized on the books of P company. Now in the books of P company, they have recorded the purchase for 600,000, and now they are selling outside for 700,000. So the gain the gain is 7 minus 6, that is 100,000. Then calculate the amount of gain on the sale of the land that should be recognized in the consolidated financial statement. So in the case of consolidated financial statement, the sale to the outsiders is 700,000 and the cost to the affiliated group is 400,000 and not 600. So the gain is 300,000. Then prepare in general journal form the work paper entries necessary because of the intercompany sale of land in the consolidated financial statement work paper for the year 2013. So again, if it is for the year 2013, so there will be the same, that we are going to have a non-controlling interest and there will be no gain on sale of land in the year 2013, and that will be substituted by a beginning retained earning for the parent company. So let us have it here, part C. And if we are going to follow the cost method or partial equity method, then the beginning retained earning for the parent company will be debit, and that is 90%. So 90% of the gain is 200. So that is 90% of 200,000 is 180,000. And there will be non-controlling interest, that is 10% of 200,000, that makes 20,000. And the gain on sale of land will be 200,000. Now if we are going to follow the complete equity method, then beginning retained earning will be substituted by investment in S company, and it will be the same 180. Non-controlling interest will be 20,000 and gain on sale of land will be 200,000. Okay, so this completes the problems on elimination of unrealized profit on intercompany sales of non-depreciable fixed assets. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or send an email, and inshallah I will reply you back. I am always here to help you. Thank you so much and happy learning.